Good afternoon, everyone. Wow, it's been the better part of 2 years that we've been doing this now. And so we just wanted to, first of all, say thank you to everyone. We've gotten out of our comfort zone and tried to deliver some content to our clients and people who look to us for some leadership in the markets. And so with the last 2 years and with these waves coming in of viruses and so forth, we're really happy that you're joining us again. So thank you very, very much for doing that. We hope that today we're going to help deliver some value in an area where we're not specialists. And so part of our job is to inquire with those specialists and talk to them and start to bring them in the fold. And so I want to introduce a couple of people who are going to join us today. I'm Antonio Rodrigues. I'm a partner here at Procyon Partners, and I chair our investment committee at the firm. We're a little over $5 billion in assets under advisement currently, and so we've got lots of people affected by these things. I also want to introduce Jeff Farrar. He is the CFP and also Chief Operating Officer here at Procyon, and Ryan Lessard. He's a manager over at Fidelity Investments, one of the largest custodians on earth at this point, I think. And he focuses mainly on the digital funds area and the research group they have there at Fidelity. So we've got the people in here. We're going to talk through this a little bit today. Something also to note, we opened up the Q&A section of the webinar. So towards the end, we're going to take 5 or 10 minutes to answer some of those questions that we see on there. So tee them up if you like. So I'm going to kick off the webinar today with a poll, as you would imagine. So you can look on your screen and you can click through, but let me just launch that here and see if we can ask this question. So since we're talking about digital assets and the role that it plays, let's think a little bit about what that is. So here's the question. What is your most used form of payment currently? Is it cold hard cash, a debit card, credit card, Venmo, cryptocurrency, or maybe you just like to carry gold bars? Whatever you think is your most frequently used form of payment, please put that on here, and I'll leave that up for a minute or two. So while you guys are answering that, let me just tell you about some of the specific goals for today. So we want to define digital assets. What does that mean? It's new, digital assets. Are we talking about, CPUs? Are we talking about laptops? What are we really talking about? And the world has opened up over the last 14 or 15 years to a new type of asset called the digital asset. And the most common form of that is a coin, or Bitcoin is probably the Kleenex version of what we're talking about here, where you know exactly what this thing kind of is and kind of what it can do. You just don't necessarily know yet why everybody agrees that there's value to it. And so today we're going to talk a little bit about what digital assets are, tokens and tokens versus coins. So for example, coins are all tokens, but not all tokens are coins. And so some of the things that kind of goes on in this world is a nuance to us, and we want to kind of learn about it. So we're going to talk a little bit about the coins, tokens, and so forth. Then you get into, as far as tokens, NFTs. We've all probably seen it or owned it or saw it either on social media. NFT is non-fungible token. So there are some unique qualities of data that get delivered through an NFT, and the type of way that it gets delivered is very specific, the technology underpinning all of this, and we're going to talk about that. So that's really important. And I think what this may even lend itself to is the idea about 14 years ago, our world went through, the housing collapse, the mortgage security kind of debacle, Wall Street, some of the banks were way over leveraged, and you had this push towards decentralizing finance, because the centralized financial system didn't necessarily protect everyone. At least that's kind of the opinion for people who are investing heavily in digital assets. And so we're going to talk a little bit about something called DeFi, decentralized finance, and that plays a bit of a role in some of the enthusiasm around these assets. So why is there enthusiasm? I mean, there's a lot of different reasons, lots of different factors. I think one of the factors is that humans tend to like to, speculate when there's value that can be derived. And so they have something that's going up in value on a regular basis, it can create enthusiasm. When it goes down to zero, the enthusiasm kind of goes away. And so yes, price movement has created a lot of the enthusiasm around what we're seeing in some of these digital assets, akin to, if a Pablo Picasso sold for $100 million one year and the next year it was valued at zero, I'm not sure that many people would be enthusiastic about those types of things. And so we're going to talk about what that means. So enthusiasm is important. But I think what we want to come away with from here really is a little bit more about the underpinnings of the technology being used. And Jeff and Ryan are going to talk a little bit about that as well. But the technology being used makes it unique in the sense that when you decentralize banking and you take it out of, let's say, the role of a central bank, you start to use what's called peer-to-peer banking. So you and I simply have a method, but how can we trust each other to do these things? And so the underpinnings of this technology helps this all occur. And so we're going to talk about that. But first, I'd like to get over to Ryan. Ryan, thank you so much for joining us. We really, really appreciate you being here. I'm going to end this poll actually and bring up the results before we get into Ryan here. So it looks like 85% of our respondents use a credit card. The other 15% uses a debit card. Anyone who uses gold bars is probably not going to tell us, nor should they. But yeah, I mean, that's the overarching theme, right? These are normal things that we use every day. So why is a credit card or a debit card not digital, right? Other than the fact that it's backed by something you earned in some fashion. So thank you for participating in that. I'm going to shut that off now, and we're going to go over to Ryan. So Ryan, if you don't mind, just tell us a little bit about your role at Fidelity, and describe some of the characteristics that you're thinking about and the way that you guys think about it when it comes to these digital assets, if you don't mind.
Yeah, of course. And thank you so much, Antonio and Jeff and the team, for having me today. Really excited to connect with the group and obviously, cover many of the topics that Antonio, you led with now, and both I'm sure will come up through the Q&A section, more at the conclusion of, our time here. But you bring up a great point, in that more so I look at this as the world as we know it is changing, right? If we think about the last decade, 2 decades of our lives and how those have shifted so dramatically, it all relates back to technology and how that's disrupted more or less every facet of our life, right? How we go about our day from the time we wake up and maybe the alarm on our iPhone to how we go to bed. And, some people maybe these days are shutting off their lights with an app on their phone or closing the blinds even with some software, technology at this point. It's really different than what we're used to. And it comes maybe to no surprise that, the financial services landscape in the world as we know it was ripe to be disrupted as well. In fact, maybe it even took a little bit too long to get to the point we're at today, where most of the systems, Antonio, as you mentioned, are fairly archaic, even if we think about credit and debit cards in terms of what they do and ultimately final settlement of those assets when you're really charging transactions through those providers like a Visa or MasterCard. So not to get too deep in the weeds necessarily and all that to start, but really how this all spawned was out of the idea of the original cryptocurrency and, digital asset, 2 words I'll use interchangeably, being Bitcoin, right? And the Bitcoin white paper was published on Halloween of 2008. The Bitcoin network went live on January 3rd of 2009 and has been running for the better part of 13 years uninterrupted, with many iterations of other cryptocurrencies since then. And as we think about the concept of what are these things, I think about the time period in which, Bitcoin really came to light and was born out of its infancy. And as you actually articulated, Antonio, that was the global financial crisis, right? 2008, 2009, where many individuals were frankly losing trust in institutions, central banks, intermediaries to handle this world properly, and more or less, with the entire financial services sector collapsing around, instruments they were unaware of. So what came out of this is Bitcoin and other cryptocurrencies, which we'll dive into, but a system of removing those central authorities, removing intermediaries, and creating a peer-to-peer ecosystem that's truly trustless. And rather than rely on individuals, at a bank somewhere that are, keeping the books and records and verifying transactions, you have a system that runs on software, computer code, that's doing this all automatically behind the scenes. And that's the general application. We'll apply a lot of the principles of what Bitcoin was to many of these other cryptocurrencies. Is, candidly, many of them are taking what Bitcoin did, tweaking the code a little bit to just be something a little bit different that serves maybe a little bit of a different need or purpose. And to your point, Antonio, about, not all tokens are cryptocurrencies or vice versa, and some of these things have different purposes of the other. We're seeing really the proliferation of what the applications are potentially of these types of assets. We've created a digital way to, show ownership, a digital bearer instrument. And now we can start with stores of value, something like a Bitcoin that's a known hard cap supply, but we can apply it to other things like artwork, which you're probably hearing as things like NFTs, right? And what are the other use cases for applications like that? Or maybe there's things like governance tokens, not something you would buy in the hope that it appreciates in value, but rather it gives you voting rights as somewhat of an owner in a company that's more structured in a new digital format rather than, the C or S corporations that maybe we're used to in this legacy world. So the applications of, these types of technology, I think, are just getting started. But it's an exciting time to be learning about much of this, and happy to expand on that more, Antonio, as you see fit.
Yeah, no, I think one of the biggest things is legitimacy. A centralized system, we all tend to agree on how it was put together, and whether or not it works all the time, obviously, is up for debate. But in large part, we could agree that a centralized system has created legitimacy, as well as some kind of accountability for that system. And so how, in this peer-to-peer, how secure is it to own something of value within this, I'll call it the blockchain technology, versus a centralized system? Meaning, can it be hacked? Can, people are like, well, my hard drive gets hacked, my Gmail gets hacked, whatever it is. So why is it safer? Why is it legitimate at this point? Can you describe that for a few minutes?
Yeah, absolutely. So at the end of the day, as I just mentioned, right, instead of trusting, a company or a central intermediary, now you're trusting computer code in the network of computers that are, running that code at any given moment of time. If we think about, the long tail of assets, there's thousands of cryptocurrencies at this point to potentially explore. I think it's fair to have skepticism in that a lot of these things aren't always legitimate and aren't always, put into market by good faith actors. So I think it's important that individuals do their due diligence on what they're owning and don't necessarily, find something that their friend or, relative said this looks cool or interesting, but rather think about the networks that exist, who is using these networks, and to what degree there's volume of transactions passing through these networks by intermediaries and institutions that can verify and trust that network that wouldn't otherwise use it, right? So the good news is in how we verify these things and how we make sure, they are upholding true values in the right way, is what's unique about them is that they're publicly viewable and sourced. So if we talk about the concept of a blockchain, generally speaking, a blockchain is just this digital ledger system that's a way of record keeping transactions when you transfer something from one person to another. So each individual cryptocurrency might have their own blockchain, right? Bitcoin has a blockchain that's unique to Bitcoin, but Ethereum also has a blockchain that's unique to that. And then many of you have probably heard blockchains aren't even specific necessarily to cryptocurrencies, right? There's enterprise uses of blockchains where a hospital might have a proprietary blockchain for the record keeping of the patients, that go through that hospital at any given time. So blockchain is more of a ledger concept of just record keeping items. And then these individual cryptocurrency networks, say focus on Bitcoin, are a public ledger system where anytime folks are sending transactions through that network, that's viewable for the public eye. Any one of us could log on right now and see the transfers that happened as recently as 10 minutes ago. Money movement from, say, me to Jeff, if I was sending him $100 worth of Bitcoin, would be publicly verifiable there. But also the first transaction that happened in 2009 is equally as public and viewable for anyone to see. So there's a record of money movement in order flow that can be traced back, again, from 10 minutes ago all the way to 13 years ago when this network launched. So I think it's important that there's like auditability of the network is how I describe it, and many cybersecurity firms doing just that.
Yeah, that's really, really good backdrop, Ryan. I think that's important. The technology really is the underpinning of a lot of these things, just like, in the 90s, the internet was the technology that a lot of other things were able to spring from, the Amazons of the world. And so that underpinning is important to understand a little bit, especially when it comes to security and the idea of currencies. And so I'm going to shift gears just a little bit here. Thank you for that. I'm going to ask Jeff a question, but before I ask Jeff a question, I'm going to ask an IRS question. At least it's a new IRS question. We won't tell the IRS your answers, I promise, but here's the poll. Let's take a look here. I'm going to share this. I want to kind of get an idea. Now, we've already determined that people watching aren't paying using cryptocurrency, but that doesn't mean you didn't trade it at all. So let me launch this here. So in last year, I believe it was tax year 2020, the first time the IRS issued a digital asset specific question on their 1040 tax form. And so all of that is evolving. We don't know the answers of all that stuff, but we know that they're asking. And so I wanted to ask, did you buy, receive, or sell any cryptocurrency in 2021? And so the reason why we put in there buy, receive, or sell is because there are some different taxabilities around how you actually get these things into your possession. And so that's important to know. So we have here of the yeses, 25% yes, 75% said no. So that's interesting. So even though you're not using it to buy things, you absolutely like to speculate once in a while, which is all good. So I'm going to end this poll and take this down. So Jeff, as it relates, we see that, we've got more and more people buying, Bitcoin or whatever crypto it is that they think they'd like to own in a speculative manner. But really, we're a fiduciary. So our firm is a financial planning firm. We serve as fiduciary to our clients. So from a planning perspective, can you discuss a little bit about some of the common questions that you get? Because I mean, people want to start to investors, high net worth investors want to start to own different types of assets and continue to diversify. But yet this is a new thing. So if you don't mind talking a little bit about, from a planning perspective, how you're handling the questions and what comes up.
Sure, Antonio. I would say as a portfolio manager who can invest assets globally anywhere, I would ask the same kind of questions. What's the risk? What's the return? What's the correlation? Is there any cash flow? Should I own one? Should I own more than one? How am I going to get exposure to what I'm looking for? So let me share my screen and show a visual to talk about some of those questions. I just picked Bitcoin as an example for the last 12 months to show you the recent price trends, right? It started at around 36,000, went into $60,000 range, dipped back to its starting point, went back to the 60,000 range, and ended the year a little bit higher, but still, very positive for the year. So obviously very volatile, although heading in an upward direction. So from a return and a risk perspective, you would want to understand that a lot of these digital assets, although not all of them, have a lot of volatility into them. The second question I would say is, even though it's called a digital currency, I don't see the US dollar versus the euro appreciating or depreciating, 30% in a short period of time. So I think about the assets as a little bit more like a stock purchase or a collectible, perhaps like a baseball card. Or I have my handy dandy example here, my favorite Pinot Noir from the Russian River Valley. It has no cash flow, but if I buy it from the winery and put it in my wine cellar for 7 years, it's more valuable when it comes out, at least hopefully. In this case, I'm going to drink all my profits, but a digital currency is worth what somebody else is willing to pay for it. So it does make it a little bit harder to value. And I would put it in a little, at least today, in a little bit more of the speculative category. How do you buy it? If you want to buy a stock, you have multiple different choices of investment vehicles to get exposure to that. And so there's lots of different ways to buy cryptocurrencies, for example. You have the question of, should I just pick one, or should I diversify my risk a little bit and buy multiple ones? As a portfolio manager, sometimes I can add a risky asset to an existing portfolio and make the entire portfolio less risky if the correlation of the new asset is less than 1. The correlation of Bitcoin, to compare it to the S&P, US large cap stocks, for example, has been trending upward, fairly recently for the last half of last year. It used to be -2 or 0, which provided a lot of diversifying benefits to a portfolio. For some reason, ever since about September, it's been trending up. It's now around about 35 or 0.35, which means it moves kind of like in the same direction of stocks, but not exactly 1-to-1. And then to your point about taxes, right? We're always thinking about taxes. Here's the exact line in your 1040 that everyone's getting ready to fill out for 2021, where they ask the question that you just read, Antonio. And if you notice where they put it, pretty much right after your name, before you get into any of the numbers, you have to answer this question, right? So it's going to be very hard to tell the IRS you overlooked this question because it came right before you started doing anything. And if you check yes or no falsely, that's going to be on your federal tax return, so it has some consequences. So, the fact that you could own a digital currency and escape the IRS attention, I think, is officially dead at this point. And then,
we shouldn't assume that. Thanks, Jeff. Go ahead.
And then I was going to say, I always like interesting visuals. I'll date myself a little bit with this character, and we don't have to do a poll. I'm sure many of you recognize the famous sock puppet, which was the pets.com leading symbol or motto in his annoying ads. And one of the ways I think about the the blockchain technology and the investments that are riding on top of it is a little bit like the internet, which unfortunately Al Gore didn't create it, but DARPA did when it came out of the military's desire to have a survivable way to share information between universities. And it's now an integral part of our life. But the point of the sock puppet is not every company that was based on the underlying technology is around today. In fact, I just picked a couple of random categories here: music, video, toys, grocery, apparel, and some of the companies that started there survive today. For example, Amazon, obviously. But pets.com and the infamous sock puppet only lasted 2 years. Ironically, there's another public company today, Chewy, who's doing exactly the same business model as pets.com and is fairly successful at it, although they do hate it if you compare them to pets.com. But it's 20 years later. So one of the questions as a portfolio manager is, you can be very bullish on the underlying technology, the blockchain, but question, are all the current applications that are riding on top of it, the hundreds of cryptocurrencies, are they all going to be around in 20 years, for example, to use this example? And probably not the case, right? So you want to have a little bit of enthusiasm for the future. As anybody who's ever sold a house and had to struggle through the reams and reams of documents required to transfer ownership, I would love it if the real estate industry moved onto the blockchain. So with a simple wiring of money, you now have sold your house to the next person, and it's traceable, it's transparent, anybody can track it. But not always are you going to have every single investment possibility that exists today be successful. Some definitely will, and it doesn't mean you want to be overly cautious, but I think you have to have a reasonable framework to say not everything will survive. And so you should be selective and probably diversify your investments and not put it all in one digital asset if you're inclined to participate there.
Awesome. Well, that's great. Thanks, Jeff. No, I think it's, what's difficult to talk about with these digital assets is regulation, taxes, and so forth. But you're right, along the portfolio management lines, we're going to think in the same kind of things. Is this aggressive? Is this safe? Is this, how can I measure this? Are there some fundamental underpinnings from which I can derive value? So one of the fundamental rules about portfolio management and finance is, cash flow assumptions. If there's no cash flow, then you have to have growth assumptions. If there's no growth assumptions, then you have supply and demand, and that's all you're left with. And so and supply and demand is a commodity or a collectible or something that's different. And so that's kind of where we wind up. So thanks for that. I appreciate that. So we have to put it in the realm of these things as well. What is interesting, though, is that a collectible isn't as liquid as maybe a Bitcoin or something because of that technology. So you can kind of see the melding of these two worlds in the future. Although talk a little bit about the backdrop in terms of why is this occurring? Like why all of a sudden? There are a bunch of reasons why. Obviously, started decentralized finance ideas, but also let's not forget that over the last 14 years, our central bank has printed 10 to 12 trillion dollars of cash. And as we know, the first time that we did that in 2008, we printed about $4 trillion of cash. That cash went to shore up banks and institutions and basically provide security that we can continue to do business as usual, right? Fast forward, that happened over the course of 2008 through 2012, 2013. Everyone remember QE, quantitative easing, Operation Twist, all these kinds of things happened. And then you have this global pandemic, which halted everyone in their boots because at the time that it occurred, there was a lack of information and data that we could use to make decisions. And so everything stopped. Fed had to come in, a US central bank, as well as other central banks around the world, and print another $4 to $6 trillion. And so you wind up with a balance sheet that is huge, or a money supply that's huge. And so what can happen is, obviously, it's supposed to happen this way, is that asset values go up. So as asset values go up, everyone's home has gone up, and but most people's homes have gone up in value. Most people's portfolios have gone up in value, whether you own stocks or bonds or something like that. If you've been a bear investor for the last 3 years, it's been tough on you. And so when you print this type of money, the way I can kind of describe it a little bit is like there's pipes built in the centralized system. And sometimes those pipes aren't built to handle the supply of money or the money supply or the size of that money supply. And you start to spring leaks. And sometimes you have to fix the leaks, and sometimes you have to build new pipes because now there's new things that are going on that we have to account for within our monetary system. And I start to look at things like digital assets, and you start to look at things like that, and you go, well, the money has to go somewhere, right? I mean, stocks valuations can't go to the moon, bonds can't go below zero. I mean, they can, but let's not make that happen. And so you start to think about what is the environment, the macro backdrop that occurs that would enable this. It's a lot of things coming together all at once. Let's not forget the pulling forward of all the, probably not all of it, but 5 years forward of demand on technologies over the last year and a half. All that demand has come into fray. So maybe the things we're seeing now wouldn't have naturally occurred for several more years. So we have all this coming together. That kind of leads me to another question for Ryan. If you don't mind, Ryan, talk, you spend a lot of time there in research and doing a lot with your team. If you don't mind, talk a little bit more as well about the broader investable theses around how these things can be looked at. So whether that's a digital currency, an NFT, a blockchain technology, how is it going to work? I mean, we think it's obviously going to disrupt different industries. It doesn't really matter. There's going to be a lot of disruption, but I wonder if you can talk a little bit about Fidelity's perspective on kind of a broader investment theme, and then a little bit about construction of how people own these things.
Yeah, absolutely. And I think Antonio and Jeff, you both hit the nail on the head, right? Where these assets are very unique in terms of they don't have cash flows, more like a collectible or commodity, and probably how you value them with supply and demand, right? The function of price is simply just that, supply and demand. The difference being of a collectible versus Bitcoin is, I think, more in terms of Metcalfe's law, and I'll share my screen here, and network effects in terms of how this currency, permeates the world ultimately, and the ownership of that and at the rate of speed of change. So if we use a common example, say mobile phones as addressed here, or Facebook, those two technologies are things we take for granted in current day 2022. They're just kind of baseline given goods that we log on to or use at any given time. But when they were first rolled out to the world, whatever iteration that was of the cell phone, or when Facebook was in, kind of beta version stage at Harvard with Mark Zuckerberg, they really weren't that useful, right? Because if no one else that has a cell phone, or if no one else that is on Facebook, what's the point of using either of those technologies, right? You can't message anyone on Facebook, or you can't share photos with anyone because they're not there to see it. Similarly, you can't text anyone else because no one else has a cell phone to receive that text on. I think about Bitcoin and digital assets in a very similar way in the adoption curve of those. And that same concept can be applied to not just Bitcoin, but other cryptocurrencies, NFTs, other things within kind of the overall digital asset ecosystem. Whereas we see the growth in the use of, say, Bitcoin, for example, it becomes exponentially more valuable to the user in the network as there's more users within that to transact with that will accept Bitcoin as collateral and a medium of exchange. So if we go through some of the stats just briefly on the slide here, a little outdated to a degree, but there's about roughly 150 million people using Bitcoin current day globally. That's somewhat out of a total addressable market of, say, the 7 to 8 billion people worldwide. Now, will Bitcoin or other cryptocurrencies ever really infiltrate the entire global population? Probably not. But we think about money in transacting value really being the underpinning of most, anyone uses on a day-to-day basis. Even if you're thinking about a simple bartering system, you're exchanging something for something else. So it has the ability to really address the total addressable market of the world population, similarly to how mobile phones at this point are owned by billions of people worldwide. So I think that's a familiar concept to most, to think about how is this going to permeate the world, and maybe how do I think about this as an investor potentially, obviously in ownership capacity. Now, outside of that, Antonio, you mentioned the point, obviously, why does someone own this, right? Like, what is their investment thesis on buying Bitcoin outside of just everyone else is owning it? And that's why I think it's a good thing too. If we focus on Bitcoin, right, most investors look at it through the lens of a store of value. And the appetite for a store of value is for all the same reasons that you mentioned, Antonio, kind of this global monetary easing, inflation, money being printed at rapid rates never before seen, and the appetite for some type of asset that has a hard cap supply, more traditionally like a gold bar, gold is a scarce metal, something that we know the supply schedule of and can anticipate what that might look like in the future. So without getting too much into the weeds on specifically Bitcoin, right? A key characteristic of Bitcoin is that there will only ever be 21 million coins, which I think is very important. And the issuance rate of those coins is on a known schedule, with new coins being minted every 10 minutes, about 6.25 every 10 minutes, and the issuance rate being cut in half every 4 years. So about 19 of those 21 million coins exist in the world, the open market today currently, with the last coin scheduled to be mined or issued in the year 2140. So that's occurring, the supply issuance schedule, over the next 120 years, which is very distinctly different than trusting a central bank of whatever country someone might live in to print money at whatever rate that they see fit to stimulate their own economy. So there's been a continued appetite and want and need for an asset that has a hard cap supply and a known supply schedule to go along with it. Now, in that same train of thought, maybe thinking about other cryptocurrencies, other digital assets, why investors might own them, a lot of investors look at it through the lens of, venture capital or early stage investing, where traditionally in most markets, investors, the average individual, maybe like myself, didn't have the accessibility to invest in a pre-IPO company with a private equity firm or however they're fundraising, these fundraising rounds before it went to market and IPO'd. With the case of, say, Ethereum or other cryptocurrencies that are building more of that decentralized finance world, I know we haven't got into the specifics of that too much, but they're thinking about more so disrupting kind of financial services as we know it, creating, again, a peer-to-peer system for transactions, using things like smart contracts to facilitate that. And investors potentially have the ability to invest in these types of cryptocurrencies or protocols or digital assets, whatever word you might want to use, before they're really mainstream and before those applications have even fully been developed on top of them. So many investors look through the early lens of venture capital that this is very much in its infancy and that there's a long run rate here potentially before this is fully integrated into our lives. Now, Antonio, another part you ultimately mentioned is how do we own this stuff, right? I think it's really unique, especially relative to, say, equities or bonds as we know it, where we own these cryptocurrencies in what I would say of one of two ways, right? You can own the actual asset, the underlying asset itself, that digital bearer instrument, say Bitcoin, where an individual could go out and purchase Bitcoin through an exchange and hold that Bitcoin with an exchange, or they could even own it on their own wallet. And we can get into the technical terms if helpful, but kind of like a hardware device, like a USB drive or something of that nature, and custody that, an important word, custody and safeguard that assets on their own accord, or trust a third party to custody those assets for them. So maybe to just dig in 1 inch deeper on that concept, I think the familiar idea is trusting someone else to safeguard that asset for you. In this case, it's Bitcoin and digital, but in traditional sense, if someone owned gold bars, they might be trusting a bank to put it in a safe deposit box for them and custody it in that way. So you're paying someone else, a trusted, reputable company, to safeguard these digital things due to the real threats that we've been thinking about this whole time. And I'm sure many of the audience members have on their minds of the cybersecurity risks or loss and theft of these assets and how possible that could be with simple scams that, truthfully, the internet is a complicated place to begin with if you're not careful. And it only so much more applies to these new technologies that we're not totally familiar with and how they work or how to really best safeguard them. So there's the concept of that ownership, Antonio. And then we're starting to see the world of, packaged products and the more traditional fund vehicles that we're familiar with, the financialization of this asset class, if you will, right? Current day, we have mutual funds, which are a collection of stocks. Rather than owning the underlying stocks, we pay a fund manager to own the stocks for us and package those up into a nice way to purchase that. Similarly, someone, not quite yet, and I'm sure we'll expand on this, but future state, there's maybe an ETF or mutual fund that owns Bitcoin directly rather than you as an investor having to own the actual asset yourself.
Yeah, no, I want to touch on that just quickly, and then we'll talk for a second about energy consumption. But I wanted to kind of make it clear that we're still in the early stages here of the term you used, the financialization or the Wall Streetization of Bitcoin and digital currencies. And so I think it's important that not all things that are supposed to track these things the way they are advertised. And that's not just true of these. It's true of a lot of commodity investments don't necessarily work out the way you want. And so there are some inherent risks, not just in the price of these assets, but also in how you own them as well. And so, certainly we'll get into that in a second, but yeah, I wanted to bring that up. Now, in terms of, this comes up a lot. Counterpoint, obviously, will be great. If it goes up in value, terrific, but at what cost, right? What's the energy consumption like on this thing? And what I've seen, there's a lot of stuff thrown around, but at this point, what I've seen most recently is that all Bitcoin mining in the world currently uses the equivalent of Thailand in terms of their energy. So on a daily basis, annual basis, the accumulation of the energy used for Bitcoin mining, all of it, currently is about the size of Thailand. If you want to bring it down to one, what I've seen is one Bitcoin mining is approximately 75 days of power usage by the average American household, right? So if you want to put it into like real terms, that's what it might be. And so that's obviously a concern. Tesla, Elon Musk recently bought and sold it and noted environmental concerns. Whether that's true or not, it's up to them. But there are some issues. So if you don't mind, talk a little bit about how you guys see that.
Absolutely. And I think it speaks to the overall efforts going on globally right now to be conscious of our energy usage as the world population and trying to preserve this world as we know it, right? The atmosphere. We're all trying to do our part to make sure we're using little energy where we don't waste it, but also making sure we use the right sources of energy that aren't necessarily dirty and further polluting the atmosphere as well. So I think it's an important nuance, Antonio, to step back even to the point, it really fundamentally start with, does someone believe in Bitcoin or cryptocurrency? Because often where I see a little bit of the discrepancy is if someone truthfully, for whatever their opinion may be, justified or otherwise, doesn't believe in the technology, doesn't believe in the use case of these assets or what the future state of those might be, they would argue that any watt or joule of electricity that goes towards that network to turn it on for even half a second is a waste, right? In their eyes, the entire network is a waste as we know it. It could use very little energy or 10x energy what it uses today, and it would still, in theory, be wasteful to them. So there's a concept in how much someone believes in the network to start with, to level set on, all right, having that next level of discussion. Now, from there, where I see it, everything's relative in this world in terms of what do we dignify as a good use of energy? Who plays kind of the role of saying this is good, this is bad in the world? And I think I say it half jokingly, but it's an honest conversation we have to have with ourselves, right? Energy and power has moved this world forward in more than we could have ever anticipated. Things that we take for granted today are ultimately powered by some source of input and energy. I'll give two examples, right? Bitcoin energy as it stands today still uses less energy than the world annual consumption of a washing machine and clothes dryer. Now, those are both great technologies that make our lives a heck of a lot easier, not having to go out with a washboard and scrub our clothes and then hang dry them over a line, right? Depending on where you live, the clothes are freezing or God knows whatever else. But it's very, very relevant in my eyes that this technology is furthering the financial system. Distinctly different things, but equally maybe important in someone's eyes. Now, similarly, in that lens, you're thinking about things like holiday lights, which we put up every year. We turn them on really for no good reason other than they look really good. And I would agree, I decorate my house just like probably a lot of other people. But again, that's wasteful energy to a degree that's really serving no greater purpose in the world. Ultimately, to get to the crux of the issue at hand, Square and ARK, two companies many investors are probably familiar with, put out a really nice paper that addressed some of this in the misconception here, where, believe it or not, 40% of the network, Bitcoin network right now, is currently powered by renewable energies. So if we think about other technologies in this world that are using a lot less renewables as a part of their overall network infrastructure, Bitcoin is pretty modern on that growth path and has a commitment by the miners who are upholding the network, the computers behind the scenes, to push towards a full green network as we know it. About 75% of the users currently, the miners, use some sort of input of an energy mix that's renewable. So maybe they're not fully renewable on their source at this point, but 75% of them are partially sourcing renewable energy at least behind the scenes. And the great news to sum up this point is that Bitcoin mining, which is really, again, for those on the phone that aren't familiar with what that word means and the concept at hand, it's a confusing term. We're thinking hard hats here in the traditional world, but really it's computers that are running the code that upholds or runs the Bitcoin network. That's all it is. We don't have to get into the nuance of that, but those computer devices are really small and compact and can be very mobile and placed anywhere in the world. And what I mean by that is you can put them easily next to a waterfall or easily next to another renewable energy source. Not the same way we can't power your house wherever it might be with hydropower if it's nowhere near a water source, right? So Bitcoin Energy has the flexibility to go more green given some of the characteristics of its mobility.
That's great. No, thanks, Ryan, for that backdrop. I mean, we often forget, you read headlines and you read things and you often forget, yeah, we do consume energy in other ways that can be wasteful. And we want to try to at least make a comparison there. Certainly the sole purpose of continuing to do it can't, or allowing it to continue can't simply be financial, but it has to be a net cost, as you suggest, right? Drilling for oil, mining for gold itself, isn't great for the environment. So there are lots of factors. So we appreciate some of that as we learn about this stuff. I'm going to go through a question or two here. We've got a few minutes left. Most of the questions, we got a bunch of questions actually, and most of them we actually answered as we went on. So not too much here, but let me throw one up here that's kind of right down the middle here, Ryan, but I think it's something we haven't touched on, and it's something that we all think about, or some of us think about. So if blockchain and Bitcoin are so traceable, what's the link to the black market? Meaning, if that's true, I mean, I also understand that one of the largest owners of Bitcoin is the Federal Bureau of Investigation in the United States, right? So I understand that they can go and find this stuff, but why do is there some ideas around why you think that there's this connection, even though there's this ledger that you can find everyone who's owned it and what they've done with it?
Yeah, I would say the reason, cyber criminals have been encouraged to use cryptocurrency over the years, if you think back to the origin of Bitcoin and others 10 plus years ago, it was even more prevalent at that period of time when the network was in its infancy. But the reason they use it is because of all, the positive externalities that are associated with cryptocurrency. And what I mean by that are fast settlement times, sending it anywhere in the globe within a matter of 10 minutes. The somewhat anonymous nature of the network, to your point, Antonio, you can track who's sending it. It doesn't say Ryan Lessard sent it, but it's a string of numbers and letters that you could ultimately trace back maybe to a Coinbase account in Ryan Lessard's name if you traced it far enough back to its origin. So the reason they use it is because how easy it is to transact in and facilitate. What they're learning over time and why we're seeing it become a lesser part of the overall transaction volume on the network is just that. It is fairly easy to trace unless you're the utmost sophisticated cyber criminal that has a very good way of obfuscating where you're sending this and where it's coming from. To give you some data and context on that, Fidelity and others, sponsored a study by an ex-CIA director to kind of look into the usage rate of illicit activity within the Bitcoin network and compare and contrast that to cash as we know it, just as, the most relevant comparison of illicit activity. What they've found is it's estimated only at this point that 1% to 2% of the network's transactions volume are used for illicit use cases. In the case of cash, that number is still between 3 to 5%. I think that's pretty important given how inefficient it still is to use cash. Ultimately, right, it can be used person to person, handing off a duffel bag, but it's not very easy to do overseas scams and activities trying to board an airplane with duffel bags worth of cash, right? So there's definitely, either sides of the coin, but I think it's important that we're seeing, digging into this, that the use of this or the rate of usage of this is coming down quite greatly given the technologies we have from a cybersecurity standpoint to track these transactions.
Yeah, no, and I think one of the other things is, what if the U.S. government decides to outlaw this, right? Like China did not too long ago, and we've talked about this internally, but I think Ryan, you had a good point about this, and I won't spoil the surprise, but if you don't mind, just a minute on ultimately what do we think from a regulatory standpoint? What happens then?
Yeah, absolutely. So those of you unaware, over the years, China's gone through ups and down processes over the last 5 years of banning, unbanning, cryptocurrency unsuccessfully, to more or less having their firmest stance against cryptocurrency just over this past summer in the June-July timeframe, where they more or less want this full, offensive of banning it, outlawing the mining behind it, closing down exchanges and any third parties that would interact with it, and really cutting off all flows to the system. Now, the reason and timing of that are two things, right? China's a bit different than the US. They're an authoritarian regime. They do things a little bit differently, generally speaking, with financial instruments and otherwise. But they were also coinciding with the launch of what is called their central bank digital currency, or CBDC. So this is a government issued token or currency that is far more digital than cash as we know it today, and can transact much quicker, kind of at the rates of speeds of cryptocurrency in terms of settlement and clearing, and moving from person to person. So they rolled out a beta phase of this, over the summer in the last 6 to 12 months, where they kind of gave out free money to individuals and citizens. And they're planning on fully launching this actually with the Olympics coming up pretty soon as kind of like this kickoff event for this, central bank digital currency. Now, this concept isn't foreign just to China, right? The US has talked openly about their plans to research, publish, data on the capabilities of launching a Federal Reserve type central bank digital currency, what that would look like, feel like, and mean to citizens within the US. I think the important thing to think about there is that these items can very much coexist, in my opinion. They're not mutually exclusive in what they're doing or meant to do. Similar how cash and cryptocurrency can coexist today. They're used for different mediums of exchange. You go into your favorite restaurant later this afternoon, they're likely going to take your US dollar bill. They're unlikely to probably take your Bitcoin or other cryptocurrency at this point in time. So they facilitate different use cases, right? At least current day as we know it. And I think the same holds true to the future, where the US would like to roll out and be competitive and improve the Fed wire system and Swift banking and how fast we can settle transactions, instead of, Western Union charging you $50 and saying 5 business days to send, some money to someone in Europe or something like that. So there's a lot of efficiencies the government recognizes to improve upon.
No, that's great. So we appreciate that. We're running right on time, minute over here. And you guys, thank you so much for joining. We could go on and on about this stuff since it's interesting. And Ryan, a great wealth of knowledge. So we do appreciate that. Jeff, thank you very much for joining and giving us some color on some of the aspects that we need to think about here. And obviously I want to let our investors know, clients and so forth, that if this is something you have a question on, certainly you need to talk it through with your advisor. We highly encourage that. Our advisors are equipped to discuss risk tolerances. We have solutions to help meet that and so forth. But ultimately, we really thank you for joining us today, and hope to do it again soon. So thank you very much and have a great afternoon.